Welcome back. For beginners in 2026, ETFs are not optional, they are foundational. Exchange-traded funds allow new investors to own hundreds of top-performing U.S. companies instantly without needing to analyze individual stocks deeply. This matters because the 2026 market rewards breadth, not bets. ETFs like S&P 500 trackers, total market ETFs, and sector-focused funds reduce risk while still capturing long-term U.S. economic growth. When individual stocks fail, ETFs rebalance automatically, quietly protecting beginners from catastrophic losses. Psychologically, ETFs reduce stress. Beginners don't panic over earnings reports, CEO drama, or short-term news cycles. Instead, they stay invested. And staying invested is the single most important success factor in wealth creation. In a world where AI-driven trading algorithms dominate short-term movements, retail beginners win by owning the entire system rather than trying to beat it. ETFs also align perfectly with dollar-cost averaging. Investing the same amount monthly into ETFs smooths volatility and builds discipline. This strategy outperforms emotional timing for most people, especially those between 22 and 40, balancing jobs, families, and rising living costs. In 2026, ETFs are not boring, they are strategic armor. But diversification alone won't protect you from inflation. By 2026, crypto is no longer fringe, but it is still volatile. Beginners should understand one rule clearly. Crypto is an allocation, not a strategy. Bitcoin and Ethereum have matured into digital macro assets, often reacting to liquidity cycles, interest rates, and institutional flows. However, emotional trading, meme coins, and leverage destroy beginner portfolios fast. A small, controlled exposure to crypto can hedge against currency debasement and technological disruption, but only when capped. The purpose is not to get rich overnight, it is to participate without risking financial stability. Most beginner losses come from overconfidence during bull markets and panic during crashes. Discipline is everything. Psychologically, crypto attracts younger investors due to speed and storytelling. This makes restraint even more important. Smart beginners treat crypto like venture capital, high risk, asymmetric reward, long time horizon. If crypto goes to zero, your life should not change. If it grows, your future improves. In 2026, survival beats speculation. Now let's talk about exact portfolio allocation. A beginner's portfolio in 2026 does not need complexity. It needs balance. A realistic framework might include a strong base of ETFs for market exposure, blue-chip stocks for stability, select growth stocks for upside, dividend stocks for cash flow, and a small crypto allocation for optionality. This structure aligns with how institutional portfolios are built, quietly and patiently. What matters more than exact percentages is consistency. Monthly investing beats timing. Rebalancing beats reacting. Long-term thinking beats short-term noise. Beginners who follow simple frameworks outperform those chasing precision. The market rewards discipline, not intelligence. This portfolio structure also protects mental health. When one asset underperforms, another stabilizes the account. This reduces panic and keeps investors engaged. Remember, the biggest enemy of returns is quitting. But allocation alone won't save you if behavior fails. Most beginners don't fail due to bad investments. They fail due to bad behavior. Panic selling, overtrading, chasing headlines, and seeking validation online destroy returns. In 2026, noise is louder than ever. Social media amplifies fear and greed at record speed. The strongest skill is ignoring it. Winners follow boring rules. They invest automatically. They don't check prices daily. They don't sell during fear cycles. They understand that markets transfer wealth from emotional participants to disciplined ones. This is not motivational talk. It is statistical reality. Psychologically, mastering behavior is uncomfortable because it requires patience. But patience compounds faster than excitement. If you control emotions, time works for you. If you don't, time works against you. This is how long-term wealth is actually built. The U.S. economy will continue evolving. AI will reshape jobs. Inflation cycles will repeat. Markets will crash and recover again. This is not new, but the speed is. Beginners who stay invested through uncertainty will own the future infrastructure of the economy. Those who wait for certainty will always arrive late. The greatest advantage young investors have is time. Compounding turns small, consistent actions into life-changing outcomes. 2026 is not a year to fear. It is a year to position quietly. In the next video, I'll show the exact monthly investing plan beginners use to build wealth without stress, even during crashes. If you want that, subscribe, because missing that strategy costs more than watching this video ever will.